appreciative that you guys are here for the third night of New Year Wealth Accelerator. We're going to have a lot of fun. I know I've been having a blast, and I've been telling everybody. So when I got off last night, my wife always asks me, she's like, well, how did it go? I was like, this group is so engaged. There's so much energy here. So you guys have got me excited, and I'm looking forward to getting into everything here tonight and making it happen for a third night. We've got one more tomorrow. And I know we went a little long yesterday. I'm going to try to be mindful of the time here this evening, so I'm not keeping you guys as late as we did yesterday. But I also want to make sure that I cover everything. So as always, every session is recorded. Please continue to take notes so that you're getting the most out of what I'm teaching. This is great. We got a big room. Just give yourself fully to the presentation, what we're going to learn here. As we've done the first two nights, I'll pause at certain times to check the questions, to make sure that I'm covering everything. And let's see. Oh, Jason's here. What's up, Jason? Nat is here. Awesome. Cool. This is great. If more people just continue to roll in. But yeah, throw your questions in the chat. I'll stop at certain points to make sure we hit that. And we're going to hop right in here. So let me get the slide set up, and we're going to rock and roll. So I just got done putting my two youngest to bed, and my daughter made a mini claw machine, like the claw machines that you see at like carnivals where the hand comes down and grabs like a prize. It's like, that's pretty sharp for an 8-year-old. So she was showing me how that worked before I got on here. So that's what I was doing before I hopped on. All right. So let me pull up the slides and let me confirm that everybody can see this. Raj, hello. Can you guys see the screen? All right, perfect. Just want to make sure, because like I said, I have taught classes where I'm talking and going over charts and nobody can see anything. So here we are, night number 3. And this is what we're going to get into tonight. We talked about candlestick charts, different parts of candlestick charts last night. We got into the moving averages, the 50, the 100, the 200. And I showed you how to set those up on your chart. And now what we're going to get into, we also went over the framework as well. But now what we're going to get into is how to actually use those charts to invest and to trade. And we're also going to talk about how to choose the right stocks to focus on, because that is a big part of the process, is knowing which tickers to select. And when you're starting out, I'm going to make it very simple for you by giving you a recommendation of 9 tickers to stay within, because they're profitable, they're reputable, they have longevity, they have positive cash flow, and they're going to be around for a long time. So I'm going to show you what those tickers are. And there's a time and place to get into more speculative companies. But when you're just beginning, you want to start with the best of the best. And I'll share that with you here tonight. I'm going to show you how to invest using moving averages, 2 simple approaches that'll make up the foundation for how you actually go about investing your money. And it's pretty simple and straightforward, and it will apply to the framework and what we learned yesterday. And then we'll get into swing trading using those same tools. Now, here's the thing. I don't want to put investing and swing trading together. It would just be too much and too overwhelming. You'd be leaving here with your head spinning. And so we're going to shift the swing trading component over into night 4. So we're going to have a lot to cover tomorrow, but we will be able to wrap everything up. And again, we're always going to bring it back to the framework and how it all fits together. So same charts, same language, different time horizons when it comes to investing versus swing trading. So that is what is on tap here for tonight. And I wanted to start with this picture here. Okay. And this is me. My first year as high school principal. I got the sharp haircut. I'm ready to take on the world. I'm going to be superintendent. Dr. Ritz is what they called me at school. I had the tie on, the jacket, and look at that guy there, right? And then you could see what eventually happened is that guy turned into this guy here. No tie. You could see at this point. And this was after I got passed over for the superintendent's job. And I was a semifinalist for the position, and I always got told the same thing. Oh, you're too young. I think I was 6 years into principal, 5 years into principal at that time. I can't remember. But it was a blessing in disguise not getting that job. So these were actual school pictures that are hanging on the wall in the high school where I used to teach, or excuse me, was a principal. But I share this with you because when I was a principal and I took a trade on my phone, the kids had left, and this was the moment where everything changed for me. And this is what really showed me the power of the markets. So I had my cell phone, right? And I had Robinhood. That's the app where I started really getting engaged with trading with using Robinhood. And not knowing much at all, I did a small trade on Snapchat, ticker symbol SNAP. And the reason why is because it was an app that my students used. And in a matter of about 5 minutes, I made $283 doing a trade on my phone. And in that moment, everything changed because I was still in the principal role. I had already submitted my letter of resignation, but I was like, how did I just make $283 in 5 minutes? Because as a principal, I would make, I think it was $396 a day is what my every day daily pay would be. And I was like, I almost made that in 5 minutes just pressing a button. And I remember calling my wife and I was like, you're never going to believe this. I just made $283. And I called my best friend, and it was just a surreal feeling. And that was the moment that changed everything for me to see, wow, this stuff actually works. And so I share that story with you to give you a little piece of when I was a principal, you know, just kind of my story. And again, I love to teach. I love education. That's never going to change. But how I got started in trading, and how my first winning trade was on my phone. And that's what showed me what was possible. And from since then, you know, the wins have exceeded what I ever could have even dreamed possible in the markets. And so when I talk about that abundance is available through trading, it's true. Now that's not to say that I win all the time, because I will tell you this. Any trader who says that they don't lose is lying. You're going to lose. And I'm very transparent about my losses. And I've had big losses, right? To the tune of not just 4 figures, not just 5 figures, but 6 figures, right? That happens. Now I'm trading large sums of money, but I share that with you so you know that I'm not someone who's just going to sit here and tell you wear the rose-colored glasses. But the majority of the mistakes that I made and the big losses came early on just by doing foolish things. On the flip side of that, my biggest trades were my winners, and not just 4 figures, 5 figures, but 6-figure trades. So I say all that to balance between people thinking that trading is just all winning all the time. That's not the case. Losing is part of this. However, the most important part, and you've heard me say this so many times over and over before, is you have to be disciplined. You have to have a plan, and you have to go slow, because if you try to go too fast, it will lead to financial ruin. Okay. So just wanted to share that little part of my story here with you guys before we jump in. Back to the framework here. The framework is capital, trend, entry, risk, and time. Everything is going to fit into this as we move through night number 3 here this evening and night number 4 tomorrow. Okay. So our framework. So what do we mean when we're talking about that? Well, with capital, that means how much and for what purpose. Really just comes down to how much capital do we have available for our investments or for our swing trades, and what is the purpose. The trend, it's the direction, like we talked about yesterday. Are we in a bullish trend? Are we in a bearish trend? And we can use our moving averages to identify that. And then we have our entry, which is where we act, where we get into the trade, risk, where we're wrong, and where we pre-establish how much we're willing to lose. And then we have time, which relates to how long the specific idea needs to be able to come to fruition. So that is the framework that we're operating in when it comes to discussing investing in swing trading. Okay. So before we get into the strategies for investing that I'm going to show you here tonight, which are very straightforward, I want to talk to you about stock selection. And when it comes to starting out in the markets, I can't stress this enough to you. You want to stay with only the highest quality companies. All right. So our rules need to be real businesses with strong products, great leadership, great fundamentals, positive cash flow. There's not negative news or massive negative controversy surrounding them. You have large institutions like we talked about yesterday, your BlackRocks, your Vanguards that have ownership of these companies. And that's important for liquidity, which we'll talk about here in a moment. And these are companies that when the market turns downwards in a bear market type situation, they can survive. And there are companies that are able to do that because they are strong enough. They have the foundation, they have the base, and we'll talk about which those companies are. And they rarely go to zero. These are companies that if these companies go to zero or bankrupt, then there's something really bad happening in the US. And we're probably talking about more than a bear market. That's how strong these companies are. And so when we tie that to the charts work best with businesses underneath of them who are strong, right? So that's why we have to focus on these high quality companies. Now, there is a tendency early on when you start investing or start trading to think, all right, oh, this stock's only $4 or $5. I remember trading Blue Apron back in the day and buying Blue Apron. And it was like, oh, this is a company and that looks cool. And I was like, it's not a lot of money. I didn't know enough about it. And I bought it and it ended up going under. And so that's why you have to be cautious and you have to put your money in those good companies. So what are those companies? You'll often hear people refer to the Mag 7, the Magnificent 7. So these are the best 7 stocks, or the Mag 8. Some people will say the Mag 9. Some people say the Mag 10. I say the Mag 9. Okay. So the Magnificent 9. And these are the bread and butter of companies out there. All right. And here are those ticker symbols. And we'll look at these on the charts here in a second. So let me annotate this. We have Tesla, right? Love him or hate him. Elon Musk is a visionary who is able to bring some very complex concepts and ideas to life that better our world. And not just with the Tesla vehicles, but with autonomous driving, with the Optimus robots, with his company SpaceX, which is supposed to IPO this year, which means it's going to be publicly traded on the market. But Tesla is one of those companies in that Mag 9. Now, of these 9 companies, it's probably the most volatile, which means that it can have some very wild swings from day to day. The other members of this group, we have Amazon, ticker symbol AMZN, right? How many of you, just throw in the chat here, throw me a 1, had an Amazon package delivered to your house today? Yeah. Okay. Right. Okay. Yeah. Right. So Amazon, if Amazon goes out of business, then there's got to be, like I said, something massively negative happening. So it's a good place to put your money in a long-term investment. AVGO, this is Broadcom. This is a chip company that has done really well these past few years. They right now are in a bit of a pullback, a correction after their last earnings report, but it's a great company. Yeah, NVIDIA is the current king of the stock market. They have, since 2023, have really just dominated the market because of their artificial intelligence chips. Everybody wants them. And it's not just companies in the US, it's other countries. And they continue to iterate new versions of chips that are more high powered, that offer more compute, and they are the cream of the crop. And so NVIDIA is one of the Mag 9. Apple, which we've talked about, we looked at one of those early tables on one of the early nights. We looked at how much money you would have made investing in Apple in 2019 and taking that to 2025. And then the others here, Meta, which it's Facebook, right? The advertising component of Facebook. They own Instagram. There's just so many eyeballs on that platform. There are so many dollars that come through ads. It is a solid company. Google, right? Google doesn't just, it's not just the search tool. It's now their AI, which is Gemini. It's Gmail, it's all that, but it's also YouTube, right? So Google is huge, and Google has been on a tear here the past 6 months. It's Netflix. Netflix. How many people do you know who have Netflix subscriptions? It's a lot, right? These are companies that are embedded in the fabric of American culture. And then finally, you have Microsoft. It's another one that just is very strong. So these are the companies we want to focus our attention on when we are getting started investing. And what I would say to you is to not put money into all of these, but study them. And when you're starting out, maybe pick 1 to 2 or 2 to 3 that you're going to begin building your core positions within these companies. Okay. And so why these companies? So deep liquidity, and this is where I wanted to talk about the concept of liquidity. So because these companies are so profitable, there is large institutional ownership of these 9 companies, meaning that your BlackRock, Vanguards, all those major investors own millions and millions of shares of these companies. And so when you go to buy them or sell them, there's always going to be a buyer, there's always going to be a seller, which means that you can move in and out of a transaction with that particular company fast. Okay. When you're trading a company that is less liquid, that doesn't have as much liquidity, that maybe is a lower volume stock, it's not one of these big mega cap tech companies, then you will have difficulty being able to sell your shares at your desired price because the liquidity isn't there. You don't have as many buyers and sellers. But with these companies, you're always going to have buyers and sellers. Okay. And I talked about too, they're followed by the major institutions, and listen, they respect the major moving averages. We're going to look at that here in a few seconds. And more importantly, after they sell off, they recover. We're going to look at the 2022 bear market here in a few moments, and we're going to see the prices where you could have bought some of these tickers and where they are today. For instance, Amazon, I believe in the 2022 bear market was trading around $84, if not less. And today, Amazon hit a price of $245 and change. And that's not even its all-time high. It hit its all-time high a few months ago. So these companies have the ability, and they have shown and proven that they recover from sell downs when they drop below that 200. And they are long-term compounders, meaning when you put your money there and you leave it there over time and you know how to invest it in these companies, it's going to compound and grow. Okay. So let me come over here to the chart, and we're going to look at these through the lens of the moving averages. All right. So let me pull this up here. Give me 1 second to do this. And I'm going to check with you guys that you could see this. And I guess I'll check in on the, I shared the wrong screen. Sorry, guys. Darn it. I always have trouble sharing my screen. I don't know why. It's not hard. There we go. All right. Let me make sure that you guys can see this, and I'm going to check the chat. You guys see that? All right, cool. All right. Yeah, so Nat says MU and AMD are good too. Definitely high quality companies. Yep. All right, awesome. All right, so I'm caught up on the chat. You guys can see my screen. All right, where did it go? Here we go. You just make this bigger. All right. Okay. So let's just take a look at the Mag 9. All right. The other thing too that I didn't even talk about is most of these guys are going to pay dividends. So Broadcom, 65 cents every quarter for a dividend, right? And so you could get passive income by owning these companies. And here's the other thing too. Some of you are probably looking at the number of how much a share of Broadcom costs. That's ticker symbol AVGO. Today, its closing price $343.50. But keep in mind, you can buy fractional shares, meaning you don't have to buy a full share. If you have $100 every month that you want to put away, and we're going to talk about that here in a minute, you can buy $100 worth of Broadcom. All right. So keep that in mind. It's not just a full share that you have to buy. But let's just look at this. Look, Broadcom respects its moving averages, right? So quiz for you, ladies and gentlemen out there. Ready? Right here, when we were in this price area, what is the trend right here? What's the trend? What is the trend? It's a bullish trend. Tell me why, based on what we discussed yesterday, we are in a bullish trend here. Right here, these candles here, we are in a bullish trend because we are what? We're above the averages. Yes, we are. Fantastic. That tells us that we are in a bullish trend. So we can see right here. So this is where Broadcom dropped. Notice it is finding support right here on my blue line, which you guys know is my 100, right? So it is finding some support at the 100. And we know that's okay. The bullish trend is still intact, right? It's which moving average do we need to be concerned with if we start coming down and testing it? So what it's the 200, right? And does anything good happen below the 200? Does anything? No, nothing. That's bad, right? Okay. So let's just go back in time here on Broadcom and let's just see what happened and what it was doing. So look, this was last December. Look at this big gap up, big bullish trend, gap down. Ladies and gentlemen, tell me when it dropped here, where did it find support? And remember, support is where buyers come in. Where did it find support and where did it bounce? The 50, right? We're just using these moving averages. It finds support at the 50, right? And then here comes February. Oh man, we come down to the 100 and we slice through it. And then look at this, guys. Let's zoom in here a little bit. Ready? We drop below the 100. And when we get below a moving average and then we try to press up above it, the moving average turns into what? It turns into what here? We talked about this yesterday. Resistance. Look at you guys crushing it, right? And it gets rejected and it tries to push above it, but boom, here it comes down and it finds a little bit of support on the 200. And then what does it do? It's moving sideways. And when a stock is moving sideways, that tells you, hey, a big move's coming. We don't know which way, but being that we're below both the 50 and the 100, oh man. And then there we go below the 200, all the way down, right? Now, check this out, all right? So these were the tariff lows, okay? $138 and change. So I'm just going to put a line here, right? So listen, this is the thing this is where people get it wrong. There were so many people during this tariff sell-off or during bear markets where they're like, oh, I'm staying away from the market. The market's terrible. Everybody's losing money. It can't go down forever. It won't. If you look at the SPX from its inception, here's the SPX chart. This is the S&P 500. Guys, this is a monthly chart. Let's go back to the very beginning of time. Look at this. We're going back to the 1800s. Here's what the market does. This. Has it ever permanently stayed in a bear market? Have we ever permanently stayed in a bear market? No. America is designed to grow, to develop, to innovate. That's what American businesses do. And the S&P 500 represents those businesses. And you could see, now here's the Great Depression here. Now that lasted for a while, but that's a whole another story. If you haven't read 1929 by Andrew Ross Sorkin, please do. It's a great read, but it talks about what happened with the Great Depression. But even that, it recovered. And it recovered that and then some. And that was a very long, drawn out period, but there weren't protections in place to prevent things like that. There are today. But you could just see here, if we go through time, we could see this was the dot-com bubble in 2000, and it recovered. And then you had 2008. It dropped, but then it recovered. So it's not permanent. All right. I'm digressing a little bit. I'm going to come back. All right. We're going to come back to Broadcom. All right. But just imagine this. Okay. And you're never going to time the bottom fully, but let's say that you were investing in Broadcom long term. And when it got below the 200, you bought some shares. And let's say that you were one of the lucky ones who grabbed it there at the bottom and rode it up to the highs. Guys, that's $277.35 per share. One share, you would have made $277.35. That's crazy. It's crazy. But this isn't the only example of it. I'm going to show you multiple examples of this. Now, let's go take a look at Amazon, because we were talking about, and we were looking at this chart yesterday, I think. Let's go look at the 2022 bear market. But real fast, guys, what type of trend are we in on Amazon right now? If we look at where we are, what type of trend is this? We're in a bullish trend, right? We're above all those moving averages. Bullish trend. Okay, great. You guys got it. So now let's go back to 2022. Here's the bear market, right? Now notice we were pushing up all that money that got printed during COVID, the stimulus, right? Pushed up. Now, does anybody know what triggered the bear market of 2022? Anybody know what triggered the bear market of rate? Oh, John, yes, you got John Doe. Rate hikes. Yeah, so I will tell you this. Right now, the Fed is in a cutting cycle, and they're going to be in a cutting cycle for the time being. Whenever the Fed is getting ready to hike rates again, prepare yourself, because you're going to get at least a correction in the market, if not a full-on bear market. But here's the bear market that happened in 2022. So from Amazon's highs here all the way down to the bottom, it got down to $81.51, right? So that's a 56.91% drop. So yeah, that's painful. That's scary. But check this out. That drop was from December 6, 2021, and it bottomed January of 2023. So that was 418 days, a little over a year. So for a little over a year, your money, let's say that you were invested in Amazon, it was down, and you had to sit through that pain, but look what followed, right? And we're below the 200, right? You see what happens below the 200. If you would have stuck with that and continued to buy more as it fell, and if you would have rode that up to all-time highs, that's $176.87 per share. It's not too bad. It's 215%, right? And I could just keep showing you more examples. Let's go look at NVIDIA. This is the crazy one. Look at this chart, guys. Look at this. Now, this split 10-1 in May of 2024 or June of 2024. Look at this run that this thing has been on. And here's a 2022 bear market. So this actually was, so it says 1074 was $100.74. But look at this move that NVIDIA went on. Look at this. Let me get my ruler. and just take this from the bottom to the top. Look at that return. That's, again, that's a 2-to-1 split. It went up $2,000 per share, right? So I'm showing this to you because bear markets happen, corrections happen, but in good companies, there is recovery, right? But this is why you don't want to put your money in like a Chewy. We were talking yesterday. Again, I'm not criticizing Chewy. It might be a great company, but who knows if it's ever going to get back to its all-time highs. The Mag 9 will get back to their all-time highs in time because they're high-quality companies. All right, let's just look a little bit more here. We're just going to look at, let's look at Google actually. And so we talked a little bit about trend. We just talked about recoveries, but notice too, all right, here's where we're below the 200, right? This is the tariff sell-off of 2025, right? We were below the 200 for quite some time here on Google. It got down to $142. And today it's trading at $322.43, right? So even though it was below that 200 for a period of time, it didn't stay there. And you could see, and this is something I want you to pay attention to as well, is that when it gets below that 200, here are things that you want to look for to see that the trend is starting to change. What should start happening is you make higher lows. So this is a low, right? But as it pushes up and pulls back again, notice how this low is higher than this one. And then as it pushes back up and then has to pull back one more time, notice how this low is higher than this one. So when we see those higher lows start to come in, we know that, hey, support is now coming in. And it's a good time to potentially add to our position, right? But I just want to show you how these companies, these Mag 9 companies, that even though they get beat up, so here's the 2022 bear market on Google. It's below the 200 for quite some time. And then, oh, hey guys, look at this, what I just showed you. Look at this. And tell me what this is. Let's see if you're paying attention. We're below the 200, but watch this. Boom, boom. What is that? And I just went over this. What do we see building out here? Higher lows. You guys are paying attention. That is support coming in. So guess what? The trend, this thing's been hanging out below the 200 for quite some time, but this is Google. This is a good company. Higher lows, trend could be changing. And what happens after that? Boom, it's back on. Google comes out of its downtrend. All right. So those are the Mag 9. All right. These are the companies you want to focus on when you are starting. There is a time and place for other stocks, but from my perspective, being conservative and wanting you to protect your money, look at the good companies first. When you get comfortable with everything, then you can expand into the others. Okay. All right. So let's come back over to the slides. Did that make sense what I went over there with everyone? Give me a 2 in the chat just to make sure that I'm not. Okay. I don't want to make sure. I just want to make sure I'm not losing anybody here. All right. So let me come back over here to the slides. All right. So we went over the Mag 9. And now we're going to get into the strategies for investing. Okay. And this is very simple. And I'll show you the actual process on how to do it with screenshots tomorrow. But there's 2 simple steps that you do, and it's not hard. All right. So this is going to be step 1. This is strategy 1. And this is setting up what are known as recurring buys. So if you think back to night 1, when I said, all right, determine if you put away $100 a month, $200 a month, $500 a month, whatever it is, that's the discretionary capital that you have to invest. Monthly, you should set up recurring buys in a broker to begin putting money away. And it should be an amount that you're comfortable with setting and forgetting and just letting it do its thing. All right. And this is for long-term investing, and it's scheduled, right? So a certain period of time every month, you could set the date. You might say, all right, the 20th every month, I have this set up to purchase or to take this $500 and split it within these 3 stocks. and you can set that up in your broker. Okay. And it reduces emotion, it's automated, and it's consistent capital deployment that you don't even have to think about. It's done on your own. Now, if you want to take it a step further, and this is where your knowledge of charts comes into play, you could say, all right, I have my money ready. Let's say that it's $200. I have my $200 ready. I have my 3 stocks that I watch. But now that you know moving averages, what you can do is say, all right, well, right now we're extended at all-time highs. I'm not buying here because it's too expensive. And you wait. And you have that 30-day window of the month, 31 days. And you say, I'm going to wait for it at least to come down to the 50. You sit on that $200, it comes down to the 50. You do your buy manually instead of setting it up recurring. But the key is consistently every month, you take that same amount of capital, you put it in those 3 stocks. Or one of you emailed me asking about ETFs and exchange traded fund. You can put that money, you could put it in the SPY, the S&P 500. You could put it in the Dow Jones. You could put it in the QQQ, which is the NASDAQ, the technology index. But you're doing it every month. And that's the consistent behavior that you're building in, that you do all the time. And again, you're using quality stocks only. And then the time is going to do the heavy lifting of compounding over time. And this is not stressful, right? It's just, just think about it. How many subscriptions do we have? If you add up, if you have streaming service, if you have internet, or I don't know what you have subscriptions, and I'm not judging what you have subscriptions to, but think about all the subscriptions, the different things that you have, right? And total them all up. And how much does it add up to? And what if you just canceled some of them? What could that number be that you now have to put away to actually grow something meaningful for yourself financially, or for your kids, or for your grandkids? Really think about that. But this is the first step of the process, setting up those recurring buys. And then what we talked about there on the first night, that $100 over 3 years is going to become that much more, over 5 years, that much more, over 10 years, that much more, 15, 20 years. It's that compounding, that time, but you just have to set it and forget it. Okay. So that's the first step when it comes to investing. It's very straightforward. It's very straightforward and it's easy. Now, here's the second strategy, and this is where your moving averages come into play. And this is where you're buying the deep pullbacks. All right. So this is best for deploying your saved capital, and you're executing when there is fear in the markets. And this is for those companies that you have long-term conviction in. All right. And so the rules for this. So these are the elite companies, the ones that you believe in, that you're committed to. You want to own Apple. You want to own the SPY. You want to own NVIDIA. These are companies that you know are going to be around, and you're willing to stick with them long-term. What we're going to do is wait, but be prepared for those moments when those companies come below the 200-day simple moving average. And just like I showed you, when those higher lows start coming in, guess what? We are going to deploy the capital that we've been putting aside. Okay. But we want to make sure that we're not buying as the price is accelerating lower. So as it's dumping and dropping, we're not just catching a falling knife. We're waiting for it to come down below that 200 to settle. And we want to see those higher lows come in. Right. And so those deep pullbacks, we're not buying because it's cheap. We're buying because the fear is spiking and it's hitting a peak when the quality remains. So just go back to the tariff sell-off that we had here this past April, or go back to the bear market of 2022, or go back to the Great Recession of 2008, or go back to the dot-com bubble of 2000. It's the same story every time. And it's a story of time. In the moment, it feels awful. It feels terrible. Nobody wants to touch anything, but that is where generational wealth is built, is when you buy strong companies at those lows. Okay. So the second strategy is buying those deep pullbacks. So you have your recurring buys that are happening every month. on those companies that you selected or ETFs. And then that's the second step is having dry powder, right? They call it cash on the sidelines, ready and being available to deploy when you get these deep pullbacks. That's step two. So when we talk about dry powder back in the day in war, they needed dry powder to load their firearms to fire in war, right? Dry powder in this case refers to you having cash on the sidelines ready to put to work. Okay. So in addition to the money that you're putting into the market with your recurring buys, you want to have capital that you're putting aside somewhere, cash that's safe, liquid, it's earning something, some type of interest. I can tell you that brokerage accounts like Interactive Brokers, if you have over $10,000 cash in them, you'll get paid interest monthly on that, and that amount goes up for more cash that you have in there. But you have it there and it's liquid, it's ready to deploy right away. And so you could be putting money away in this brokerage account, in a high yield savings account. And the sole purpose of it is preparation. You're sitting on that money, you're growing that money for when your opportunity comes, when those elite stocks are in areas where they're beat up below the 200 and you start to see support coming back in. That's when you deploy that capital. And then what happens is you have your recurring buys, you have the purchases that you've made at these lows, and that's going to accelerate the growth of your portfolio. Because think about it. We just looked at Amazon, which was $177 that went up from the 2022 bear market to today. And then we looked at Broadcom from the tariff lows to its all-time highs. It was like $200+ Think about that, right? Even a small number of shares is going to produce a huge return. Or imagine this. Imagine if you would have bought NVIDIA when it was $103 in October of 2022, and it went up $2,000, right? So even though it feels scary to buy in those moments, if you're setting aside funds for the exclusive purpose of buying when stocks drop below that 200 and start building out those higher lows, you're going to put your money in a position to grow for you at a faster rate, right? And so this is a very true statement. This money has a job. It just hasn't been called into action yet. All right. It's like the closer, the pitcher in the bullpen. All right, come out and do your business. Right. And it's that simple. It is that simple. It's your recurring buys. It's you have your money that you're putting aside, that you're building up that cash pile to wait to deploy when you get a massive pullback. Or you could even do this. Let's say that we're in a super strong bullish trend and you don't think that we're going to get below the 200, or your chart study doesn't say that for a company that you own. And so maybe the cash pile that you build, it gets so significant that you say, all right, well, hey, we're down at the 100. I'm going to deploy half of that and I'll save the rest for if we come back down below the 200. So you could start making those types of decisions too, right? It's all part of the learning process and growing and just becoming more comfortable with the decisions that you're making. So how this works together with recurring buys, the synergy, not really talked about this. So your recurring buys are small, consistent investments every month. It's deployed regardless of what's happening, right? These purchases are happening monthly. It builds your long-term exposure over time. And essentially what you're doing is dollar cost averaging. So if you're buying, let's say you're buying at $100, maybe the next set of shares you buy the next month are at $90. They call that DCAing, where you're basically, as you're buying lower, you're bringing down the average price at which you own the company. And then your stream two, that's your strategic cash, where it's larger chunks that you're saving intentionally to utilize during deep pullbacks when fear is high, and you're using it on only elite companies. And so recurring buys build the positions but your deep pullbacks are what is going to accelerate it. All right. So let's just take a pause here. Does that make sense? What questions do you have and how can I help? So let me just go through, see if I miss anything. Yeah. Robinhood. Yep. Between SMA and EMA, which one should be used and under? So simple moving averages are better for your swing trading, long-term investing. Your EMAs are relevant for day trading. You can use them as indicators for intermediate support and resistance on your swing trades, which I do, but they're not 100% essential. Dry powder's funny. Yeah. Natalie here, do corrections typically happen every 1.5 to 2 years? Yeah, that's accurate. I used to know these statistics off the top of my head. In terms, bullish cycles last longer than, bullish cycles last longer than bear cycles. And I believe that you'll get a bear cycle every 4 to 6 years. I might be off on my time frames, but just going back to look at the bear markets let's just go back to 2000. You had one in 2000 that was pretty significant. You had one in 2008. I think you had a minor one sometime in 2011. You had the COVID bear market, which was the shortest in history. It dropped 35% in a matter of days, and then it went on a massive run. You had the bear market of 2022. And then you could call the tariff drop a bear market just from a technical perspective because it dropped 21%, but it didn't last very long. So what has been happening here in recent history is that the downturns have not had a significant duration. And the last really long duration bear market that we had, you'd have to go back to the Great Recession of 2008, which it took a pretty sizable amount of time for it to fully recover. And so there are some people out there, I call them the doomers, who are like, oh, we're getting another Great Depression, we're going to zero. But even if something like that occurs, it's an opportunity. Now, you're going to have to be patient through it. But if you're only investing money that you can afford to, right, that you don't need, and that's the way that you should do it, then you're going to be fine. And in fact, you're going to be more than fine whenever the market recovers and pushes back up. Yeah. So, and I actually did a whole webinar, and I'll send it to you guys tomorrow in the email that I put out, but I did a webinar on bear markets and corrections. So a correction is defined as a 10 to 20% decline from the all-time highs. So you could drop 20% and it still just be a correction. It's whenever you get below 20% that it turns into a bear market. But here's the other part. Corrections are healthy, especially in bull cycles, because they reset valuations. And you probably have heard the concept buy the dip. That's when capital reallocates itself and gets ready for that next leg up, right? Just like what happened here this past April. Do you sell when market indicates a bearish trend? So if you're investing, no, you don't sell. You stay invested until however long your time frame is, until you start withdrawing that money. When you're trading, that's a completely different story. You know, let's say that you're in a swing trade. You've got to monitor the trade to know when the trend is shifting. And there are lots of ways that you could protect yourself. But typically what'll happen is you'll see the signs when a bear market's coming. It doesn't announce itself, but the trend will start to reveal itself over time, where it's all right, like what happened this last February 2025. It will show itself. And there are things too. So the more advanced that you get into this world, you could do things like shorting stocks, where you could profit off of stocks as they go down. Or you could do with options what is known as buying puts, which, again, I'm not trying to confuse you. These are more complicated topics, complex instruments, but basically put options, you make profit as a stock price comes down. The put options go up in value. So you could just buy and sell put options. That's the thing about the markets. You can make money when the market goes up. You can make it when it goes down. Isn't it 10% pullbacks per year and 2.8 for 20%? So it's not an exact science. 10%, 10%, 10 plus percent corrections are fairly common. I don't have the exact numbers in front of me, but 5% pullbacks, I think you typically get 3 to 5 of those per year, and you'll typically get a 10% correction 1, maybe 2 times per year. And again, the bear markets are more spread out, spaced out. And we are right now in a pretty significant bull cycle, but we are just how far up we've run, we are getting due for a pullback. Melanie says most of the Mag 9s have the same order of SMAs, 50, 100 below, 50 and 200 below, 100. What does it mean? And what does that mean? And what does it mean if that's flipped? If the 200 is on top and the 50 is a low. So there's just going to be, it's best to look at a chart here. Let me pull this up. And I don't want to spend too much time here because I want to make sure that we cover everything. All right. So this is, let's actually just take a look at Tesla. So it just depends on the different chart. So remember that the 50 is going to be more relevant, more recent, right? So we could see here on Tesla that is tighter to the price action right now because Tesla's been in a stronger bullish trend. So really Tesla's moving averages are ordered properly for a bullish trend. You've got the 50 on top, you've got the 100, and you got the 200. So that's a sequence that you'd want to see for a bullish trend. But what happens is as you start to move down or chop sideways, these things can get tangled, right? Like we see here, like we see down here, where it just can kind of be a mishmash. And that's just because of the price action just doing some squirrely things. And there's not necessarily any rhyme or reason, but basically what you'll see is when you're moving up into a bullish trend, is those moving averages begin to fan out, right? And that 50 hugs the current price action because that's the most relevant moving average, the 100 being next to 200 coming after that. And so again, as the price starts to come down and those moving averages start to converge, that's when you could see the order of them start to shift, just because the trend begins to change and you get fluctuations in the price. So really just look for the fanning out of the moving averages, right? And then look for the order of the 50, the 100 and 200. And again, whenever that trend starts to change and they come together, that's when you can get some really squirrely combinations. But a look like this right here that we're seeing on Tesla, that just indicates that we're in a bullish trend, right? And we have been for some time. All right. And let me hit a few more of these because I want to make sure that we get through everything. These are great questions, by the way. Is there a place? So we're going to get into stop losses tomorrow when we talk about swing trades, but for investing, you're not going to have a stop loss for your investments. Can you address how to take advantage when there are swings from one sector to another? So that's really beyond the scope of what we're covering here, but what you're talking about is rotation. So basically, you'll hear people talk about in the markets there being a regime change, where for the longest time here in this current bull run that we've had, it's been the mega cap tech that has been driving this bull run. So those Mag 9 stocks that we've been talking about, your NVIDIA's, Meta, Tesla, they've just been ripping higher. So they've been providing the leadership in the market to drive it up. While that's been happening, your other sectors have been underperforming, and the breadth of the market is what you'll hear people talk about, which is other sectors being involved: healthcare, biomedical stocks, oil stocks, energy, although energy has been very strong because of AI. But we haven't seen full participation from everything. However, in a healthy market, what you see is rotation out of leadership, out of big tech, which we saw a little bit of that happen in October, really from July into October. So it shifted into small caps, some of the high beta stocks, and really, if you look at the moving averages and trend, when something or when a sector gets really far extended, like big tech, the Qs got really, really extended, it gets to a point where the valuations become astronomical. And at that point, your large institutions start taking profits, locking in gains, and taking that money and putting it elsewhere into sectors that have space and room to run higher. And it just depends on seasonality, what sectors tend to run at certain times of the year. There's also what are known as cyclical. And again, we could get into a whole conversation on this, and I don't want to go down the rabbit hole or scare anybody away. That's a whole nother concept. But basically, rotation happens out of different sectors into other sectors. And like I said, I could talk about that longer. I just don't want to lose anybody. Can you see my screen? Because I see, I'm not sure if you want to have your video overlay of yourself. Oh, you know what I didn't do? I didn't do this. Darn it. Sorry about that, guys. There we go. Let me just run through these. What is the most effective seeing and tracking rotation? Again, I don't really want to spend, what I'll do is I'll put something in the email. It's more about rotation, since I'm getting a lot of questions about that. And I want to address it, but I do want to get through everything here with you guys. What about the history of the Nifty 50? Again, we're already at 9:31. I would love to hit on these. I don't want to keep you guys up too late. So let me just keep moving on here. All right. We're almost through. And I appreciate you guys being here the whole time. Okay. And so the last thing that I hinted on this. So when it comes to those recurring buys, the last thing that I want to say, and I talked about it briefly, if you don't want to set up the automated purchase, and if you feel comfortable with your moving averages, what you can do is just have that cash on hand. And let's say that it is a Micron. Here's a chart of Micron right here. But let's say that you're getting ready to make your purchase for the month. And you look at the chart and you see, all right, here's Micron, and it's at all-time highs. Well, you know, based on your understanding of charts like we've talked about and the moving averages, you're not just going to buy right here at all-time highs. It doesn't make sense. So what you could do for your recurring buys is wait, right? You know you're going to make a purchase that month, but what you could do is say, why am I going to buy this thing when it's the most expensive it's ever been? And you could say, I'm going to wait for it at least to come down to the 50. And so you can hold on to that money if you want to manually do it, wait for it to come down to the 50, and then execute your buy before the month is over. Or let's say that it drops even further. Then you got into the position, or you dollar cost average at a cheaper price. And you can now do that with your understanding of moving averages. Okay. How does this fit into the investing framework that we talked about? So I'm just going to briefly go over this to tie this back into the whole capital trend and all that. So capital, right? We're putting our money only in the best stocks. Our capital, your hard-earned money that you've worked for, that I want you to protect. I want you to be conservative with. I don't want you to be risky with, right? Your capital deserves quality, right? And it should be the best stocks. And it should be fewer names that you have high conviction in. You know, the big institutions are involved with those companies, and you're determining in advance what your monthly number is that you're going to begin putting aside and actually investing it. All right. Because that's the other part. You can sit and write on a piece of paper. All right, starting this month in January after this class, I'm going to start putting $100 away every month, recurring buy. I'm going to start building my dry powder up, and I'm going to start my process. You can write it down all you want, but if you don't execute those buys, you're not taking action. You got to take action. The trend, our trend, we are identifying the trend on TradingView, looking at the daily, weekly, and monthly timeframes, candlestick charts, and we're looking at our simple moving averages, which you guys now know how to read. With time, we're talking about the recurring buys. We're getting consistent exposure every month. We're removing the emotion. We know we have X number of dollars every month that we are buying our handful of stocks that we want to own, and we're letting the compounding doing the work, while we also are putting money in our dry powder. So we are ready to put that money to work when we get that huge, massive opportunity, right? Because we don't panic and freak out when the market's in a correction or there's a bear market. We are saying, all right, we're going to build generational wealth, right? That's what I want to take the fear out of those moments for you. And you're also not going to have that fear because you're not going to be invested in garbage companies. Entering risk, deploying that dry capital below the 200 simple moving average. So your capital will save with purpose. When the fear peaks, you're putting it to work. Only when selling slows and you're seeing those lower or those higher lows come into play. And here's the beautiful part of all of this. You're not guessing. You're using a system. You're allocating your capital with intention. All right. So this is not just, oh, hey, I'm going to buy this. No, you have a simple, basic framework with your moving averages, with candlestick charts to start doing this. And again, you want to start small, but this is enough to begin. And while you're doing this, you could be learning more and expanding your knowledge base, expanding your skill set so that you just are continually getting better at this. But you're getting started now with good companies, with strong information on how to make your purchases. And this is what's going to get that ball rolling for you. All right. So I met with some friends today. We were having a cup of coffee and we were looking at some charts. So here's another, yeah. You got to love AI. I typed in, I was like, hey, give me a picture of a cat, a dog, and a moose looking at TradingView. Which one is me? Probably this guy right here. He's probably like, he doesn't look too happy. But you know what's weird? This is where AI is goofy, is the chart is here on the back side of the computer. Yeah, looking at Chewy again. Yeah, that's probably what this guy is like, man, why did I put my money there? And this guy's like, ooh, look at my Amazon today. Amazon, and this moose, the moose is probably an MU, right? So I think the moose's portfolio is just smashing higher. The cat's starting to go up. And then our pal Rusty here, he's allocated in Chewy, so he's not feeling too good right about now. Anyway, I had to put some humor in there after all that content. All right. So that is the content for night 3. I know we went longer, guys. We get going. And then when you ask your questions, I feel bad not answering it fully because I want to, like with the rotation, I feel bad I didn't spend more time on it, but I don't want to go too long. But here's where we're going next. And this is what you now have. You have a way to choose stocks intelligently. You know the top 9 companies to focus on. You have a calm method to build positions over time. This is the investing component of it. We're getting into the trading component tomorrow with swing trading. And it's not day trading, it's swing trading, all right? And this is a plan to use volatility as a strength, something for you to capitalize on and not be fearful of it, not be afraid of it. So when everybody else is saying, oh, the market's horrible, it's terrible, you're saying, this is great. It's the Warren Buffett quote. It's right. And one of you put it in the chat the other day. It's be fearful when others are greedy, be greedy when others are fearful. And it is true. And you have a framework to guide every one of your decisions. We're going to add to that tomorrow and we'll reinforce it. We'll review all this. And so understanding how all this work is the first step. It's consistency. It's applying this over time in a structured way and doing it over and over and over, those repetitions, that's the challenge. And I shouldn't have put this picture on here, right? You see this, the 4 screens. I have a laptop, I have a MacBook. That's all I use for my trading. You will never see me having all this nonsense. I got one screen, that's it. And I always say, less is more in trading. Complex equals losing money. So if you want to be complicated and fancy with all your crazy indicators and all that, good luck. That's a recipe for losing money. You don't need all that stuff to make money from the markets. Proof of that. And so this picture should not be on here. So that's an editing error on this guy's part. I'm sorry. That's because I was too wrapped up in making an AI picture with a moose, cat, and a dog. So that's my fault. All right. So tomorrow night we are going to look at actively trading using that same framework for swing trading. So I'm going to show you how to do that, how to set an entry point for a swing trade, how to set a stop loss, how to set a profit taker. I'm going to show you how to put that into a broker. I'm going to show you how to set up a recurring buy in Robinhood, and they'll just be screenshots. I'll show you how to do just a typical, if you wanted to just do a buy order for shares and interactive brokers, I'll show you how to do all that. And it's going to be our final chapter tomorrow. That's crazy. We'll talk about why execution and discipline matter more than strategy, because here's the thing. Knowledge is abundant in the markets. It's the actual execution of it, and it's the discipline. The hardest part in this process is following the same set of rules over and over again and not letting fear and your emotions take control. And that is how traders and investors lose their you-know-what. All right. I'm not going to drop a curse word here. We'll talk about how traders avoid common mistakes, what support, structure, and accountability actually look like. And then I have a ton of free resources for you guys that I'm going to give you. So I want to make sure that you're leaving here with some cool stuff tomorrow that you can use, some tips and tools, some great people out there in this world of the stock market that you should be paying attention to, who really just share valuable information. So I'm going to share that with you. And we'll have the $100 drawing. So that's going to be coming up too. I think I covered everything. What questions do you guys have as we wrap up? Anything? You guys are welcome. You're welcome. So I'm just looking at some of the questions here. Do we need to time monthly activities like ADP, job data, FMOC, some thoughts on how to leverage these? You can. And as you become more sophisticated with your investing and your trading, you're going to want to, again, you could go very deep with all this stuff with economic data. Now I'm a nerd with it. So I know, when all those dates are, and I monitor it all, but you don't need to be an economist or into geopolitics to invest and trade. You really don't. But you should know big dates like Fed rate decisions, Jerome Powell press conference, inflation reports. Those are very big right now. So, things like that. But you got to be careful because you really can go down the rabbit hole in this world and never come back like this guy, right? Some of the stuff that I've fallen out, it's insane. But yeah, you want to know some. Jeff in here says Mike Jones rocks. Mike Jones does rock. So I'll share this with you tonight. So, and I'll put this in an email. But if you want to start learning more about markets, the economy, micro, macro economy, economic data, and from a guy who is just a genuinely down to earth, great dude. And he is brilliant, but he'll never say that about himself. This guy, you want to check out his YouTube channel. It's Mike Jones Investing. And a lot of you are here tonight because Mike gave me a shout out on his channel. But this guy, I have him on my podcast every year. He's a phenomenal individual, and he is just a great mind when it comes to the market. He really is, man, he's just a gift to this space. So check him out, Mike Jones Investing. He's a Chicago Bears fan. So I told him I'm rooting for the Bears in the NFC for him this year. Awesome. Yeah, he's the man. Yeah, the fibs with the golden pocket, fair value gaps. Yeah. Again, you can go down the rabbit hole with all this stuff, but start simple. Don't overwhelm yourself. Start small. Don't overwhelm yourself. That's the best thing that I can tell you guys. All right, I'll close out with this. So I was gonna do this yesterday, but I didn't. I had $200 gift cards that I was gonna give out. So we're gonna give those out tomorrow. But we just got so into everything, and we went long again. It is what it is. I just want you guys to know, I appreciate you. I appreciate all the questions that you asked. I appreciate the energy that you brought here on the third night. I mean, you continue to show up. So that's awesome. And I just want to thank you so much. And I will see you guys here tomorrow, the final night. I'm going to bring it. We might go long again because we have a lot to cover, but my gratitude to you guys, and I appreciate you. Videos coming tomorrow. Have a great night and take care, everyone. See you guys. Thank you.